Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Thursday, November 4th, 2021, and I am pre-recording this Trading Places Live for just a little bit later this morning. Let's see. Currently, we have futures, which are a little mixed this morning. Got the Dow Jones futures down 13, S&P 500 futures up 5, NASDAQ really rolling, up 53. Almost 54 points this morning pre-market. Oil, which had a rough day yesterday, we're seeing crude oil futures are actually crude oil up $1.63, a little more than 2%, back up to 82.50 per gallon, or excuse me, per barrel. It seems like it's 82.50 per gallon. And U.S. 10-year Treasury yield is pretty flat right now this morning at 1.58%. We did have the Fed meet yesterday. We'll talk about that in just a couple minutes. Let's take a look at the agenda for today before we get started. I'm going to start off with the daily market recap, go into talking technically. I'm going to talk a little bit about ChartList, one of my favorite things to talk about. Not only have I used ChartList in my trading for many, many, many years, but our business at earningsbeats.com is really built around the ChartList feature over at StockCharts, whether you're a StockCharts member or not. We use the ChartList feature and you're going to benefit from it either way. But if you are a member at StockCharts and you're an extra or pro member, all the chart lists that we generate at Earnings Beats, you can download right into your account, literally in seconds. All the research, hours and hours and hours and hours of research that we pour into the market at Earnings Beats, we store a lot of that research in chart lists, and then we basically just hand it to members who download it. So it's a pretty cool feature. So I'll be talking about that for just a little bit, and then get into the earnings spotlight and then wrap up the show with the three you must see. I will mention that between yesterday and today, there are about 1,000 companies reporting earnings. These are the two biggest days of the quarter. So it's usually the beginning of the second month of the quarter when you get into the huge number of companies that are reporting. Now, most of the biggest companies have already reported, but this is like that second tier, and the reports have just absolutely been pouring in between last night and this morning. I'll try to go through some of those with you as we work our way through the show. All right, so with that, let me go ahead and take you over to earningsbeats.com. If you're not familiar with us, I hope you'll get familiar with us. I think we can help in your trading and investing. Been very bullish on this market for a long time, and we're literally getting a melt up right now. If you'd like to try our service, the paid service, there's a 30-day free trial. So you can check it out for 30 days. I'm telling you, this is the best time to check us out because number one, it's free for 30 days, but it's been that way for a while. We've got a couple of big events coming up. The draft of our 4 primary stock portfolios, what I call the draft, which is when we can select the 10 equal weighted stocks for each portfolio. That occurs on November 19th. So all of our members, our paid members, are invited, including our free trial members. So you can check that out. I mean, our portfolios have performed extremely well relative to the S&P 500 since inception. We also have a draft of a new portfolio that we created last, was August 10th, which has outperformed the S&P 500 by, I don't know, 2.5 percentage points in one quarter, which is pretty strong. But we were testing it last quarter. We're going to do it again this upcoming quarter. That draft takes place on November 10th, which is next Wednesday. So that's another reason. But even the biggest reason, I would say, is that we have our fall special coming up, where you can sign up for an incredible value if you want it, if you like our service. And again, if you don't like it, you haven't lost a cent. But if you do like it, our fall special coming up is going to be the best opportunity to lock in a great deal that we're going to offer all year. So you want to check that out. Anyhow, scrolling down, if you just want to try to get used to what we do at Earnings Beats, I would say the best way is to listen to this show and then also subscribe to the free Earnings Beats Digest newsletter. It's completely free, no credit card required. You can unsubscribe at any time. We're not going to give you a hard time. You say you want to unsubscribe, you'll be gone. But we do write this newsletter, publish it 3 times a week, Mondays, Wednesdays, and Fridays, usually about an hour before the market opens. It's a very simple read, a couple paragraphs and a chart, but I think it'll help Essentially what I'm trying to do is, based on all my years of experience doing this, is try to pay something back to the community. That's why we just do it for free. And I think it's a great newsletter. I think you'll enjoy it. Hopefully pick up a few tidbits. We try to make it educational, but also it could be a trading opportunity. Of course, that part's up to you, but all you need to do is put in your name, email address, hit that subscribe button, and we'll get you started. All right, let's move on to the market action from Wednesday. It was another great day. We had the Fed come out at 2 o'clock. I'm going to show you what happened after 2 o'clock in just a minute. But as a recap for the day, Dow Jones Industrial Average up another 105 points, a new all-time high record close of 36,157.58. S&P 500, new all-time high close, 4660.57. NASDAQ, new all-time high close, up more than 1%, by the way. So clearly beating both the Dow Jones and the S&P 500. But the NASDAQ closed at 15,811.58, another all-time high close. And joining the party recently, mid-caps, the S&P 400 mid-cap index, up 1.13%, another 32 points yesterday. You got it, another all-time high close. And for the first time in a long time, I can say that the small cap index, the S&P 600 small cap index, at an all-time high close, really surged yesterday, up more than 2%, 30 points to 1437. I mean, the market has got it in gear right now. The Dow, S&P, and NASDAQ have all confirmed these moves with new highs in their AD lines, accumulation distribution lines, as you can see, and mid caps and small caps are turning up as well. So when I look across the major indices, here we are in November, the most bullish period of the year historically, and we are flying. So this has been great action. Clearly another leg up in this secular bull market. Discretionary stocks leading on the sector side. I've been talking about discretionary really since probably back in September, because even when we were struggling on an absolute basis, look at what the S&P was doing in September, going straight down. So what this, if you look at relative charts, which we do all the time, very frequently, you'd see that the discretionary group has actually been outperforming the S&P 500 since back in August. So when we broke out right here to a new all-time high, and we were already showing leadership, I mean, you can see what's happening. We're having a melt up in discretionary stocks. So it's so important to follow, not just on an absolute basis. Don't just listen to CNBC waiting to tell you that you're finally at an all-time high. Look under the surface of the market. That's what we try to do in this show. And that's what we do in our service at Earnings Beats. We try to look under the surface and give us the best shot of figuring out what's going to happen before it happens, not after it happens. Anyway, materials up over 1% on Wednesday. Staples up 0.9%. Both these groups showing much more strength. Obviously, they were weak a month ago. Now they're strengthening, look very good on an absolute basis, especially materials, which took out this $86 level. That was nice. Still got to negotiate the highs from back in June, July. So we got a little bit of work there. Staples getting close to its high. You might say, well, isn't that bad? Staples are jumping to an all-time high. You know, they're defensive. They shouldn't be going to an all-time high. That's not correct. It's fine for Staples to go to an all-time high. In fact, we want defensive stocks moving up as well. We want everything breaking out to all-time highs. What we want is discretionary stocks leading Staples. I don't care that they both go up. I just want discretionary to be leading on a relative basis when we're breaking out. And I think that's pretty clear. If you pull up a chart, discretionary versus Staples, I mean, the line is going straight up. So discretionary is doing very well relative to Staples, which is bullish for the market. Healthcare also up about 0.6%. So this is a group that's righted its ship as well after struggling for about 6 weeks in throughout September and early October. We've come roaring back, getting close to an all-time high breakout there. On the flip side, we've got energy down 0.8%. Yesterday, crude oil was down, I don't know, maybe 3% or so. I don't remember. I didn't really look to see what the final tally was. But today it's bouncing back. So it's back up over 2% this morning. So I expect we're going to see another move back to the upside in energy shares. But I'm still not I know I'm a broken record, and I know energy's done well. And I've wish I'd been more bullish throughout the year on energy. But I do believe that this is within the confines of a long-term downtrend, relative downtrend in energy. So yes, we've had a very strong 2021, but go back and take a look at 2019 and 2020, especially 2020 during the pandemic, because we fell off a cliff. So what we've done is we've gotten that back. We are not in a long-term uptrend on energy on a relative basis. So as much as we've seen a great 2021, it's mostly because we had such an awful 2020. Energy was way worse than any other group. And energy, believe it or not, since 2013, when we broke out above the 2000 and 2007 top on the S&P 500, energy is barely up since 2013. So I'm not worried much about not being on board energy for the last 8-9 months, because I wasn't on energy for the last 8 years when it did nothing. So maybe it goes higher. I do believe the economy, the global economy strengthens, and that certainly will help prop up crude oil. I just don't know how much more, maybe a pun intended here, but I don't know how much gas is in the tank for energy. All right, let's move on to the 10-year Treasury yield, because the bond market, one of their biggest days of the quarter, or maybe a couple times a quarter, is when the Fed announces their policy statement. And so the Fed spoke yesterday. Essentially, the Fed is going to begin tapering later this month. So it's going to taper its bond purchases. So it doesn't mean it's selling its bonds. What it means is it's not going to buy as much. So it's been buying, I think, 90 billion. Double check me on that, but I believe it was 90 billion. They said they were going to slow it to 85, or maybe it was 95, slowing to 90. I don't recall. Then next month, another 5 billion. They're going to keep that pace up, they said, but they're going to continue to watch economic conditions. And they believe that this is going to be seamless. It's not going to be a problem. But if it is, they said they're ready to change course. So they're giving the stock market really what it wants to hear. It's like, okay, you're telling me that things are so good that you can begin to taper your purchases. That's good news. And you're also saying that if things start to go awry, you're going to turn around and change course again to help the stock market. And I mean, you might say that, well, the Fed's interfering. You know, there are a lot of folks that are on the other side of this saying the Fed does too much. But if you look at their mandate, what they say they want to do, they want to maximize employment. How do you do that? With a strong economy. And a strong economy benefits the stock market. So the Fed's job is basically to prop up the stock market. It's not anything new. They've always been after maximum employment. That's number one. And the other is to stabilize prices. So inflation is a big concern of theirs. Our economy is a big concern of theirs. That's what they're trying to do. Anyhow, they came out yesterday. They talked about tapering, and the market kind of took it in stride. I mean, a lot of times we get a lot of whipsaw action, but for the most part, we were just strong after the Fed announced. The 10-year Treasury yield jumped, so you saw a little bit of selling in bonds. That's what causes the yield to go up. But did that money go to the sidelines? No, it went right into the stock market. That's the rotation. That's what drives the stock market. Everyone gets so upset because yields are going up. I get excited because yields are going up, as long as they don't go shooting up. I think this steady move up, if a year from now we're sitting at 2.5% Treasury yields and you're thinking, wow, that's just too much. I believe if we're sitting at 2.5%, we're going to see a stock market that's higher, maybe much higher. But I do believe we got some issues coming up in 2022. And as we get closer, I'll be talking about that. I think Market Vision 2022 in January of 2022, when we do that event, I believe it's going to be a very interesting discussion. Let me just leave it at that. Yeah, I think 2022 is going to be a very interesting year. Anyway, we're getting close though. And let me, before I move on, I just want to tell you that in terms of economic reports this morning, we do have initial jobless claims coming out shortly. 277,000 is the estimate. So we're slowly moving lower and lower. I'll tell you what, I see job openings everywhere in every walk of business and life. So I'm not sure who's filing for jobless claims, but there are jobs everywhere. Q3 productivity will be out later this morning. The estimate there is for a drop of 1.5%. By comparison, quarter two, we saw productivity pick up 2.1%. So we're looking for a reversal there in Q3. All right, let's move on. Let's talk about the S&P 500. So what kind of reaction did we have? Well, we finished almost right on the high, finished at 46.60. The high was 46.63, so only 3 points off the high. And you can see it seems like the momentum is picking up. It's just picking up. And that's good news. It's good news for anybody on the long side in the market. Very, very bad news for those who are shorting the market. And many people ask me, why does your research, or why do your chart list only look for long candidates? Why aren't you looking for short candidates? And I just look at the market and I'm just bewildered by the question. Why would you want to try and short this market? The S&P 500, look at this, since the bottom and right before earnings season started, we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 days of what I would say are neutral to very bullish, 13. And I've seen one day that was bearish, and that closed out that historically bearish period on October 27th. That's been the only bad day. What are you shorting for? I don't understand. You know, if somebody said, listen, you can swim in the ocean with the current, or you can swim against the current, I'm going to swim with the current every time. I don't understand why you would want to pick swimming against the current. And that's what you're doing when you're trying to short the market. Anyhow, I know there are some who are very successful at it. It's not for me. And I know not all companies are participating in this move to the upside. So there certainly are opportunities to short. I just think there are more opportunities to be long. And that's why we do what we do. All right. I wanted to show you, though, let's look at the 5-day, 10-minute chart. Look at what happened at 2 o'clock. Now, if you're familiar with these days after the Fed announces, the 2 hours after they announce at 2 o'clock Eastern, usually what you see is this huge move up and then a big drop back down, then back up again. It's like head fake central. We didn't see any of that yesterday. I mean, look at where we were, 46.25, and we finished at 46.60, and it was pretty much a straight line up. I mean, there's a little bit of selling maybe at around 205, something there, 207, a little bit after right here, that little pullback, but otherwise it was pretty much just straight up. And this comes with the news that the market has been expecting. And that's what the Fed's been very transparent. And I don't worry about the Fed announcements because I really don't believe that they're going to lay a bomb on the market. I mean, we could see a negative, reaction temporarily, but I just don't see the Fed being the reason that the market drops. Not yet, not at this point. I think we're a ways out from that, a long ways out. But anyway, that's a discussion for a later day. I just love the reaction that we saw, not only in the bond market, because you see the bond market mostly went up, came back down a little bit, but finished higher from where it was at 2 o'clock. So that just means that there was net selling in 10-year Treasury yields, and that money made its way over into the stock market, which is awesome. I thought also what I would do is talk a little bit here and talking technically about the global market, some of the other markets around the world. I mean, we just said the Dow sets a new high. The S&P sets a new high. The NASDAQ 100, the mid caps, the small caps. I mean, you look across the sectors, it's unbelievable how many new all-time highs we're seeing. So what's going on around the world? Well, I'm going to show you. So first, I always like to start with Germany because the German DAX, in my opinion, has the strongest positive correlation to the S&P 500. So it always makes me feel good. It's almost, to me, it's a little bit like the Dow theory, where you're looking at the Dow Industrials and also the Dow Transports, how one kind of confirms the other. I look at the German market in kind of a similar light. I like to see Germany breaking out when we're breaking out in the US because they are positively correlated. So I don't want to see one breaking out and the other lagging. Now, the DAX has not broken out yet, but you can see clearly it's going up, just like the S&P 500. A lot of hollow candles, meaning closing above the open. So I like all of that. I believe the German DAX is being accumulated. And even though we haven't yet broken out to another all-time high, I think it's coming. So the DAX, I think, looks very strong. Moving over into Asia, let's look at the Nikkei. More sideways action. We got right up, tested that high on the Nikkei from February of 2021, couldn't get through, pulled back, held the lows, and I think we're working our way back up again. So not quite the same kind of pattern as the S&P, because the S&P has been breaking out throughout the year. But the last 30 days, I think you can see that we are moving in that same direction. The Hang Seng, HSI, Hong Kong Hang Seng, been downtrending. So you can see there's obviously no positive correlation here between what's been going on in the US and what's been going on here. However, what I am seeing is a possibility of a bottoming head and shoulder pattern. Left shoulder, neckline, head, right side of the neckline, right shoulder. I'd prefer this right side of the neckline to have been upsloping slightly. Instead, it's downsloping. So not only do I want to get above this neckline, which is downsloping, but I really want to clear 26.5, that the left side of the neckline. If you get through 26.5, then I think you got got something to talk about there. How about over in China? So the Shanghai, this one, just for fun here, let's go down here to correlation, because I get questioned plenty of times about, well, such and such is going on in China. How's that going to impact the US? Well, let me pull up a 20-year weekly chart, and I'm going to show you correlation between China and the US down here on the bottom. Now, you see all of this up and down. We're in positive correlation. We're negative correlation. I would say over the last 6 years, we've mostly been in positive correlation. But, I mean, we go into the middle and into the negative correlation a lot. And you can see over the last 20 years, I mean, prior to the last 6 years, I would say it was almost 50-50, maybe slightly tilted toward positive correlation. So in other words, it doesn't matter what's going on in China versus what's going on in the US. This is what this chart's telling us. I don't worry about what's going on in China. It's a huge market, but the correlation between what's going on there and what's going on in our country is really almost the correlation. I'm not going to say it's non-existent, but it's a little bit more of a crapshoot. Now, I mentioned the DAX was so positively correlated. Look at the last 20 years on the DAX and the S&P. Do you see the difference? So are you more concerned about what's going on in China, or are you more concerned about what's going on in Germany? I say it's Germany. But, again, I'm looking at it from a US stock market perspective. And the indices, or the index that really, the foreign index that correlates most positively with the US is the German DAX. All right. So anyway, that's kind of a look at some of the key indices from around the world. Let's keep moving on. Still got a lot to cover here in a short period of time. Chart list. So all I wanted to do with the chart list today is just kind of show you a sample of a chart list. And this is the upcoming chart list for upcoming earnings chart list for companies that reported yesterday after the close and today before the open. And what you can do with this is you can hit this view all, go into summary form. Now this will tell you what they did yesterday, but this will be the first chart or first chart list that I look at this morning. I will look at this because at 9:31, this chart list has all the companies that reported last night and this morning on it that have market caps over $1 billion. And you can see there are 269 of these companies. Tonight, after the bell, there's going to be a ton more. So we have a chart list for tonight after the closing bell, and tomorrow before the opening bell. That all goes in the chart list. And what you can do is simply check this out at the very open to see what's gapping up and what's gapping down. Why is that important? Well, let me give you an example why. There are market makers that typically are on the other side of trades when there's an imbalance between demand and supply. So look at a stock like Solar Edge yesterday. Solar Edge, look at what it does. It gaps down on massive volume. Everybody's selling at the open. What do you think market makers are doing? They provide liquidity. They're buying. So if you got retail traders selling at the open and market makers buying at the open, who do you think is going to make the money? The market makers. They got a lot of capital. So a lot of times these gaps, the reason they fill is because you have our market maker system. So that's one on that side. How about Sprout? This is an internet stock, Sprout Social. This is going the other way. Here's your big gap up in the morning. That was a great shorting opportunity. So now do you see what could be the benefit of at 9:31 opening up to see which stocks are shooting up and which ones are shooting down? You might be able to go opposite and make some money. Some keep going. So you want to make sure you have your stops in play. Sometimes what I do is if I do a strategy where it gaps down 10%, and then it goes down, it's 13%, down 14%. I wait until it gets back through the open. When it gets through the open, sometimes I'll take a position. But anyway, this is a great way to trade the market. And anybody can get this. You don't even have to be a member at Earnings Beats. When you subscribe to this free Earnings Beats Digest, we provide these chart lists for everyone who's part of our community. So you can go in and look at these chart lists, or if you're a StockCharts Extra Pro member, you can download them right into your account. All this work. You want to go ahead and enter all these into a chart list, 269 of them, be my guest. But we already do it for you. Check it out. Anyway, chart lists are a great feature at StockCharts. All right, so earnings. I mean, only got a few more minutes here, and we're going to just include this along with the 3 you must see. So we'll kind of do the last 3 earnings as the 3 you must see. But there are so many earnings out this morning. Qualcomm had a big report. What I'm going to do is just give you the morning, the pre-market action going on right now. Still almost an hour and a half before the open, but let's take a look at Qualcomm and some of the others. These are just companies that reported last night after the bell. Qualcomm up $13, 9.86%. They beat. Booking Holdings, an easy beat, 37.70 versus 31.56. Stock up 4.5%, $111. Equinix, EQIX, beat on their top or bottom line, 694 versus 669, down $22, $815, down 2.6%. Metlife, 239 versus $166. You want to know why all these PE ratios are so high? Because the market's anticipating blowout numbers. That's why. It's not because the market is overvalued. Like I read in so many different areas when I'm looking at different authors and so forth that I like to read, or I just see headlines and I click just to see what they're saying about earnings. It's the same old, same old. You're trying to compare 2020 or 2021 to 2000 or 2007. We've got completely different markets. We have huge growth. We have massive earnings, and we have historically low interest rates. I've valued companies. Trust me, these valuations are still low on these companies. Roku crushed their estimate, 48 cents versus 6 cents. Stock down 7%. Sometimes it makes no sense. Electronic Arts, up 265. They beat $167 versus $117. HubSpot beat by 6 cents, 50 versus 44. Stock down $16. Crazy. That was I thought, a pretty solid report there. How about Etsy? Etsy reports. This will be the first of the 3 you must see. Let's check this out. So Etsy down $162, but trending higher. I think anything down the upper 220s looks pretty good there for me on Etsy. Next up, let's look at MGM, which actually posted a profit. Market was expecting a loss. MGM up 92 cents or 2%. Looks pretty good in the last one. How about Take-Two Interactive? $1.58 versus $1.35. Nice surprise there. Stock up 3%. Looks like it's trying to break out above that June high. All right, I'm going to wrap up. I appreciate you tuning in. I'll be back next week on Monday at earningsbeats.com for your next Trading Places Live. Have a great rest of your day and enjoy your weekend, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.